Started my first startup in '97. The world told me I was insane.
Our goal is creating future economies that are more regenerative and sustainable.
Something didn't match up. Why hasn't this become the next big thing? And that's where we invested.
The whole purpose of achieving anything in life is measurement.
I do appreciate the Shadow team for including me in this event and speaking. I think it speaks kind of to the confidence of KP and team to be inclusive of VCs like Ironspring that are ultimately playing in the same sandbox of sorts. Similarly, subscribe to the rising tides notion. I'm quite happy with collaboration across our ecosystem of founders, sector-focused VCs, strategic CVCs, and corporate innovation hubs. I really think this collaborative spirit is a bit unique in our sector, and I hope our networks continue to grow together, because at the end of the day, what we're all trying to accomplish is pretty dang important. Our focused industrial legacy industries are massive in scale, effectively serving as the backbone of functioning society. They're essential and were labeled as such through COVID, although we've known this all along. And really, until as of late, in really this year, amongst the broader community of generalist VCs, the venture community has largely ignored our industries, as well as the associated skilled laborers that are just too important to be left behind this current digital wave. So I'm Adam Bridgman, co-founder, managing partner of Ironspring Ventures. We're a sector-focused, independent venture capital fund focused on digital industrial innovation. We have an early-stage deal focus with typical check sizes, 2 to 3 million, in the proper natural reserves for being an enduring capital partner, starting in the early innings. So we're built for industrial operators, by industrial operators. The partnership team comes from the space, investing and operating over the last 10 years. And we're supported by a network of partners spanning the industrial value chain globally. So strong alignment from LPs to the investment team to the companies that we're wanting to invest in, share a vision to digitize the industry. It all starts slowly but surely, and we're seeing some really just positive signals in the market and momentum and adoption that we imagine will continue to snowball. But I'll keep this pretty punchy. I know there's been a lot of eyeballs at this event, and to avoid burnout, I'll move pretty quickly here and try to get us through, in 20, 25 minutes or so, open it up for Q&A. Maybe even put some time back on everyone's calendars, but just high level, quick agenda. Going to go over macro perspective on the global VC state of affairs. I'll chat about kind of honing in a little bit on macro perspective for industrial AEC venture capital in the startup ecosystem. Some recommendations to VCs and corporate and CVCs and startups in the space. And then just some trends, and might get into some tech discussion on a few key emerging trends that we're seeing. So just high level VC industry quick hitters. We're already in a record year in venture capital deployment, deals and dollars. So new global funding year over year is up almost 160% off a record year last year. There's been 140 billion in deployment in the first half of 2021. I think we saw close to 140 unicorns through the first half of 2021. This is the broader VC global ecosystem. I was reading in PitchBook that they're expecting within the next 6 months, we'll likely see for the first time non-traditional tech investors, i.e. hedge funds, mutual funds, and the like, will actually invest more in private tech companies than traditional Silicon Valley VCs. So there's kind of a changing of the tides and where dollars are being deployed. There is a lot of frothiness, I suppose, is one way to put it, but there's a lot of capital being put to work right now, and tech is always a hot area. Our industries are starting to become very, very hot. But the new remote world is also enabling and facilitating talent dispersion and expanding geographic investment scopes. I think for the first time also, the Bay Area will fall below 20% of U.S. deal count. It's kind of how it's the trajectory through end of year. So people are building businesses everywhere. Talent is being spread everywhere. Middle America is heating up in terms of tech talent hubs, proper support from the venture capitalization community. And we're seeing a lot of efficiency gains kind of as a silver lining. One of the other interesting tidbits is there's many large institutional VCs have really adopted an indexing model to the venture asset class. And it's enabling incredible deployment velocity and almost near immunity to valuation. It's led to valuation expansion, particularly in the later stages. It's creeping down to the early stages as well. When we look at just kind of the full subset of venture across all industries. So to kind of summarize state of affairs, general VC market today would barely be recognizable by a time traveler from 10 years ago. What used to be an A round is now routinely called a seed round called the pre-seed round. There is so much money being put to work in the general venture asset class that once pretty basic engagement mandates, whether it's board seats or governance rights, or even working with the company hands-on, those things are not as prioritized from kind of the growth stage institutional VCs, because it takes away time away from that VC to chase the 4 or 5 more deals that they're looking to bucket in. And so the heat map of venture is trickling to digital industrial VC, where we play and where Ironspring plays, and where many folks in the audience are operating, whether startup or corporate or a sector-focused VC or a corporate VC. We all care about the built world in our legacy critical industries. When we zoom in on this, we are seeing incredible momentum in terms of opportunities for founders, startups to secure financing and build enduring businesses that can weather some of the adoption hurdles our industry still face. And we're seeing a handful of domain experienced, early stage, sector focused VCs even raise larger funds and kind of double down on the model of supporting founders in the early innings and the most challenging cycles of their business build outs. This is all positive for founders, and quite frankly, it's attracting a lot of new smart people to innovate and build companies in our space. We're seeing a surge in investment from the generalist growth stage VC ecosystem as well, to allocate partners, resources, dollars to industrial tech in the Series B plus stages, and really try to replicate some of the indexing model that's going on in the global VC asset class in other more established digitized industries to the AEC space. It's happening for a few reasons. Massive market, big TAM, regulatory tailwinds in the form of pending infra spend, successful outcomes like Procore IPO and new public exit options like SPACs, a more aggressive universe of private buyers, whether that's incumbent construction tech incumbents or private equity consolidation strategies and roll-ups. The universe is changing in our world, and it's attracting more dollars as one of the bigger opportunities. And this has, been a trend for the last 3, 4, 5 years, but it's happening in a much more aggressive fashion this year. We're also seeing corporates find creative ways to support new innovation. So whether it's through CVC investment on founder-friendly, non-restrictive terms, to innovation programs that help steer and enable sophisticated pilot and commercialization opportunities for startups, to upgrading to a more flexible API strategy. I think this trend of collaboration and open sourcing a bit, at least in the form of integrations and APIs, is going to be something that ultimately kind of weeds out the folks that build their technology moat and rise to the top of the hill or not. So we're seeing corporates, customers across the board become more aggressive with their strategies to adopt new solutions and drive change management. But there's still, a handful of challenges and big challenges. Are we really seeing productivity gains? Not yet, maybe not yet, but it is coming. Are we seeing point solution overload? Yes, but that's a natural part of the innovation cycle for non-digitized industries, and ultimately things will kind of naturally select itself out. But it does cause some initial pain points for folks in the ecosystem, whether adopters, customers, commercializers of new technology, or startups, founders looking to carve out their niche and expand their product with quick product market fit to enable a bigger platform play. There's a lot of competition for eyeballs, and it's still a fragmented ecosystem with different systems, different perspectives, different scopes, different spin on IT and innovation. It's a difficult world to traverse as a founder, but it's starting to become easier, and folks are enabling it to become easier. Are there too many data silos, too much fragmentation? Yes, but we're of the opinion that natural selection will take place, and the folks that are API friendly, open source curious, integration specialists will be standing on the hill when it's all said and done. So my kind of high level recommendations to key innovation stakeholders and industrial AEC tech for Ironspring and sector focused VCs like us, there is a need to, and will continue to be a need to, specialize and go early, or face the risk of being commoditized out by large institutional generalists deploying their indexing model and kind of spraying large checks across the ecosystem without necessarily understanding some of the nuances and risks and hand-holding that takes place, at least in the early innings of startup growth. Ultimately, it's a helpful driver of adoption. It's a helpful catalyst for founders and smart people to enter the space and attempt to innovate. They know that there will be a capital stack behind them if they succeed and perform well. The exit outlook is more positive than it's been before. The buyer universe is kind of catching up. There's somewhat of a defensive chess piece match that will be taking place among the incumbents. And so the landscape as a whole is healthier than it's ever been for startups. It's getting trickier in the form of real partnerships from the VC community, from the CVC community, with folks that are innovating and also adhere and enjoy that form of kind of one-to-one partnership in the early innings of their life. Again, B rounds are looking like A rounds are looking like seed rounds, and it's moving pretty quickly. So advice and recommendation for strategic CVCs and corporate innovation hubs, be as friendly as possible with little to no restrictions on investments or governance requirements. Typically, it's best practice for kind of the VC path, if a startup chooses to go down that path, to follow an institutional VC, whether sector focused or generalists. Follow a lead and join the syndicate in either the very early innings, where the most value can be had, pre-seed rounds, or strategize around an investment mandate that carves you into later stage deals, where the winners are more obvious, and you can put larger dollars to work and fundamentally drive incentive alignment off larger dollars into bigger companies, i.e. more commercial exposure and alignment. And so general recommendation is go very early, go very late, be very, very friendly, syndicate partner. If investment is part of the mandate, in terms of innovation hubs, it's also incredibly helpful to kind of adopt a fund-to-fund strategy. If one of the goals is to engage intelligence and improve network effects, partnering with sector-focused VCs in terms of commercialization, helping to facilitate and guide a streamlined engagement. With the pace of innovation and the surge in innovation capitalization, there is a lot of companies that are doing cool things and have a semblance of product market fit. It's incumbent upon all of us to give these folks a chance, but it's also incumbent upon the startups to present themselves in a way that makes it very easy to integrate or to trial or to pilot or to adopt. It's a recommendation for startups, focus on innovating the industrial ecosystem. Let's make sure from the outset you're very intentional about your path to market. You want to make sure you're building you're not trying to squeeze a solution and find a problem for it. So surrounding yourself with a founding team, an early team that's very complementary, domain experienced, very intentional around kind of your path to market, whether that's going to be pursuing the VC fundraise model. It's a model that works for companies that are looking to grow quickly and have the opportunity to grow quickly. It's not a model that works for everybody. Great companies get built all the time without going down the VC path. As a venture capitalist representing Ironspring, we think it's an excellent path for the folks that have discovered their product market fit, want to be capitalized in an enduring way, and move as quickly as possible. The reality of our industry is it's relatively nuanced and things take longer, and it's difficult to mirror some of the other industries that T2, D3, kind of triple, double, and meet expectations of the venture capital community and other industries. It's a difficult thing to achieve in our space. And we, along with a handful of other kind of sector-focused, domain experience, early stage funds, Shadow obviously as well, it's understand some of the nuances and challenges in the early innings. I think it's very important to take a very hands-on approach if that's desired, and help navigate some of the fragmentation and partnership strategies and channel partners that can really flywheel growth, flywheel product market fit, and position companies to look like a venture play, and ultimately be able to produce a SaaS scorecard if it's a true SaaS business that a growth stage generalist VC can look at and understand TAM and help capitalize further. But our whole goal in the early innings is to kind of handhold and get to that place, and it's a challenging time, but it's much better than it was 5-10 years ago. It's improving every year in terms of the ability for companies to grow and receive funding and drive real commercial adoption. And so other recommendations for startups, make sure you're not building a solution to try to identify a problem. Legacy industrial industries and supply chains are very fragmented, complex, very much not automated, or even readily accepting of change. So without clear product market fit, it's difficult to gain traction at the outset. It's important to have a very simple engagement model that removes as many friction points as possible with potential customers. So streamlining pilot plan and expectation setting, producing ROI-based milestone plans to conversions and expansion. In terms of VC and fundraising, I think you want to be very mindful of your capitalization needs, at least For the immediate to near term in our space, we think methodical, measured growth and the appropriate capitalization is important to take into consideration and not get ahead of your skis. We've seen a handful of groups that kind of got caught in the venture bubble and construction tech space in 2017 and 18, needing to recapitalize and restructure, not because it's not a great company and has a great opportunity, but just that it the company was forced into a position to accelerate too quickly and burn capital too fast, ahead of where the industry was willing to accept growth and adoption. So it's very important to take a measured approach in our industry, and whether that's in construction or industrial supply chain, infrastructure, prop tech, real estate tech. Things move a bit slower here, and it's important to kind of know your intentions at the outset. And then also deciding on the type of partner and the level of engagement that fits your style and value system, whether that's hands-on, someone taking a board seat, or leaning more into kind of the indexing model that's taking place from some of the larger generalist guys of capitalizing very robustly many companies, but being less hands-on in how they want to engage with their portfolio companies. And so those are a few of the lessons learned. We are seeing a great number of startup breakouts. And it's exciting to see folks that have been building methodically for the last 2, 3 years, 4 years, have reached level of adoption and product market fit, that the wave of generalist VC money is attracting, is gravitating towards them, and it's producing really solid rounds for very smart, domain experienced, bold innovators. They've kind of paid their dues in some ways and navigated a lot of the complexity of our ecosystem and built a nice company with solid product market fit, pursuing a big vision, and they're able to kind of by luck, but mainly by hard work, be in a time frame right now where the capital markets are hot, and I don't foresee that stopping anytime soon in terms of just venture deployment. Funds have been raising like crazy left and right, and most of them have allocated resources, time, partners to investigate our space, and help identify the winners and fund fund the few that have an opportunity to really capture a large piece of the market. So the other kind of key consideration for some of these startup breakouts, other than understanding the space cold and having product market fit, what we've seen is kind of a consensus trend among groups is it's a very balanced founding team or early team with domain experience, complementary skill sets, experience in operations, but also experience across the team and building a SaaS business, and scaling to industries that have difficult change management, working with partners and channel partners to accelerate growth and flywheel some network effects, and utilizing the existing infrastructure in place to gain traction, whether that's through existing commercial channel partners, tapping into a variety of groups that, as opposed to displacing, can augment your solution. And then the other kind of key thing is that we've seen across some of these startup breakouts is really over-indexing, especially in the early innings, to simplicity of product, simplicity of messaging, ease of use in general. Many are over-indexing to customer success support. Becomes very, very difficult, especially in this world we're living in now, where the handful of innovative, large customers and corporates that are willing to pilot and trial and invest in new innovation are being overloaded by opportunities. In many what we call pointy solutions in some fashion, while many groups start out as pointy, the ultimate goal is to build upon kind of a niche and growth and product market fit and build more to a platform. But in the early innings, it's difficult for large corporates to navigate some of these waters and try everything. The groups that are able to kind of break through that initial resistance just by way of simplicity and clear expectation setting, very, very clear pricing models that are ROI based, integration specialists, hands-on kind of customer success and support for supporting integration needs, for supporting any sort of change management that's required as part of the product, whether training or automation training. They typically get that flywheel effect of getting in first early, and then if they're able to actually perform, it becomes very, very sticky, and groups don't want to keep changing systems. It's not natural in any industry to find something you like and pivot out quickly. And so it's a race to stickiness, and that happens by way of simplicity in initial integration and adoption. And so that's kind of key recommendations there. And maybe I'll pause for a second and open it up for any chat or questions. Ian, I'm not sure if you're on and wanted to engage with anything, or Nick, but
yeah, no, definitely. So, and I wanted to offer anybody who's joining right now the opportunity to even share your camera and audio to ask any questions of Adam. It's actually quite a treat to have him here and giving an hour of his time to answer any questions that you guys have got. He's got a breadth of knowledge, so really take advantage of that. Adam, if you want to share your camera too, you're more than welcome. But yeah, if anybody has a question, feel free to either put it in the chat or the Q&A. Nick, if you've got a question, you can ask one as well, and then we can just keep the conversation going. But thanks so much, Adam. This has been really insightful.
I wrote down a list of questions.
Oh, great.
I was paying very close attention to what you had to say. Just trying to learn from the best. All right. So I liked what you said about, venture firms, strategic investors, people who are new to kind of the venture investing scene. In the phrase you said is they're getting ahead of their skis. It's very easy to get ahead of your skis when you enter the market. Can you describe like what that feels and looks like? Like how do you know if you're a venture investor? Like how do you know when you've gotten ahead of your skis?
Well, from a startup perspective, and I guess that's where I was kind of orienting around, there's a lot of money in the market right now. And there's a lot of folks that are interested in AEC industry, tech, and innovation, kind of by way of generous venture capital. I mentioned earlier that, the C rounds look like Bs, Bs look like Cs, rounds are expanding in size. That's all fine and dandy for industries that can kind of automatically flywheel growth and like traditional SaaS, maybe in fintech space, where you can triple, double, and you can really build into some of these valuations that are taking place. I still think our industries, for the majority of groups, the A's still look like A's and the seeds still look like seeds. And the folks that are kind of methodical and intentional about how much capital they actually need to hit certain milestones tend to do better in the long run. And so they could still reach this outsized Series B growth round. But it takes a little bit longer, and there's more navigation in the early innings. We tend to think it's better to partner with a sector-focused VC in the very early innings. We think there's value there, and ideal syndicate is maybe a generalist VC with some exposure to the space that has best in class networks, and some of the traditional benefits of venture and governance, but just being a hands-off investor at the very early innings, I think is ultimately kind of challenging to founders and startups, even ones with strong domain experience. Getting ahead of skis, I think it's just being intentional from the very outset of starting your business as a startup, planting your flag that you do, first off, want to go down the venture path, because it does kind of set off a chain of events and expectations. And it's a very great way to fuel business. But you want to be careful about how much money you take in, because ultimately capital efficiency is important. You want to make sure you have a product market fit that's real, and that you kind of have a projectable pipeline and growth metrics that can build into a solid outcome, as opposed to getting priced in to potentially your best outcome too early. And so it's hard sometimes to, it's tempting, big dollars, big valuations. It's a good problem to have, I suppose, and it will work out for folks. It might pose to be a challenge for others. But just having that outset, or that mindset at the outset of how you want to grow your business, so that when you come across these situations, if things are going well, the decision becomes a little easier.
Yeah. So Adam, internally, we were having this discussion earlier today, and I think, I don't know that we have tons of concrete data to support this assumption, but I think we all internally at Shadow feel like there is like a major increase in terms of mainstream interest and exposure to the build sector, from generalist venture investors, and part of our thesis is like maybe there's a lot of talk about the infrastructure bill and how important it is to fund our bridges, our roads, our critical infrastructure, and how important construction tech is, and AEC and prop tech is to fulfilling that and gaining leverage through technology. But I think one thing that I think is interesting with you, and I want to make sure we get your feedback on this, is like, you've been investing from a venture perspective in this industry for longer than most. Like, I remember when you came up to the Built Worlds event in 2017 with KP, like you've been around the block. Like, you've seen companies succeed, you've seen companies fail, you've seen like huge successes, the plan grids, you've seen some of the blow ups. Can you talk about like the evolution of venture within this particular sector, and like where you think we are right now? Like, do you think we've hit a crescendo in terms of mainstream interest yet, or are we just like, are we in a bubble and just feeling that?
Everything is overpriced across the board everywhere. And so I think the mindset of the venture community at large is you have to play the game, and the winners will ultimately return. It's still like a power law game in some ways. And so you're seeing it from Index and Insight and Nacelle, kind of this indexing model of putting large dollars to work, immunity to valuation in many regards, because a lot of cash has been parked in these investment vehicles that invest in tech companies. And so that whole group has kind of migrated to what's the next big TAM. And that's been our space for the last couple of years. And, there's been a lot of dollars put to work over the last 10 years in technology companies. And, the Procore IPO is great for the space, and some of the SPACs have taken place. So there's been momentum, but I think it's really been this year where there's been this massive shift. And it's kind of by way of the size and scope of these funds, and the need to invest in large, significant opportunities, the TAM that our spaces represent, the tailwinds of regulatory infra spend. There's just a lot of events that are kind of confluencing right now, and so I don't think we're in the middle of generalists coming in. I think it's going to be a much bigger wave over the next 5 years. It'll be probably the most invested industry along with crypto. And so it's exciting to be in it. For founders, it's awesome. There's like the road to get capitalized is much easier than it's ever been if you build a strong company. But the buyer universe is probably lagging. And so that's what I was kind of mentioning, not getting ahead of skis. The exit outlook has improved and is getting better and better. And whether that's private markets with incumbents kind of opening up their war chest and playing defense and picking off companies, or if it's kind of a continuation in the private equity world of consolidating some of these construction tech startups, platforms, whether it's legacy incumbent groups with new groups. And then there's, IPO opportunity as well, and we'll see how the SPAC markets evolve. So it's all kind of catching up, but I would say venture is usually early, and there's a lot of dollars coming to work. Our industries just represent kind of an untapped space still. And until, we have a system in place and, it's fragmented. I don't know how it will evolve in terms of consolidating among some of the stakeholders and buyers and users. I think it'll continue to consolidate. But until there's like a frictionless way to scale a company, which is not going to happen anytime soon, there's still a lot of nuances in the early innings. And it's important for people to be methodical around their pacing and their growth, and realistic. Like these industries will produce a lot of really great companies, but it's going to take some time.
I've got a follow-up question to that, actually. When you talk about, the TAM of the built environment, and what can you say to, I guess, the popularity factor, right? And you look at,
we're sexy now.
Right, that's what I was right. So I'm just curious. Like you look at, the surge of crypto and, different investment industries, and like maybe the U.S. infrastructure bill plays that if it passes, and if it, in the scale that it's being proposed. Maybe that's a contributing factor, but when is the built environment and construction tech going to hit this kind of sexy factor? And, with that brings a lot of attention. So I'm just curious your thoughts on that.
Well, we're in it now. It's kind of been sexy for a couple of years, and I'm really happy about how the ecosystem has evolved. There was a handful of kind of sector-focused VCs playing in the early innings. There's maybe two of us, like 6 years ago. Some that were kind of small and a couple spin-offs. And now there's a handful of groups that are focused on it and represent, LPs that have a stake in the game as well. I think it's a nice network effect. It's probably needed. Now all those funds are raising larger funds. Because the model works, and obviously the opportunity is real. There's really, really smart people looking to build companies. There's just been an influx of teams and smart founders, whether they come from the space or partner with someone from the space or just learn about it and find an opportunity to build. There's incredibly smart people building businesses, more so than there ever has been. And it's because it's sexy in some ways, but also because you kind of follow the money a little bit too. No one's going to try to build. I mean, some people do, but it's difficult to find the motivation to build a company if you're never going to get adopted by customers, and it's a limited ecosystem of capitalization to raise money. And so that's kind of how the industry's been for a while until the last few years. And this year has really catalyzed kind of exponential growth in rounds at the growth stage plus. I don't think it's going to stop anytime soon.
Adam, one question I had, and this is like I'm kind of cherry picking my own research here, but I think one thing that mainstream investors don't understand about our sector is actually, like, from a financial perspective, like when you're looking at recurring revenue, a lot of companies in our industry, you could consider, they might define their revenue as recurring, but it's actually on a project basis, right? Like we have this unique situation where like, companies and enterprises are buying for a specific project. Maybe they have budget on that project, et cetera. And like the project doesn't renew, it's one project. They might have more projects within the company that, that they'll take on over time, but it's not quite what we all think is recurring revenue. I'm just curious if you all have like thought about that dynamic. Like, do you see it come up? Like my understanding is most venture investors, when we've interacted with them, they kind of gloss over it. Like they just, they take the startup's word for it. They don't really factor in some of the nuanced considerations of what is recurring and what's not. But have you thought about that or seen that at all?
For sure. Yeah, I think it's very rare for a company to go straight into an enterprise deal, whether it's like let's just use GCs, for instance. It's very, very rare for a startup to build a company and immediately win an enterprise deal across all projects. And so it's, when you're evaluating things from the venture lens, it's very natural to see companies start project by project, and it's probably the most realistic. And so expansion across projects is important to track when you're looking at growth trends and outlook. Obviously, success on the projects that you've been on. If you're doing well there, it's pretty natural for it to continue to expand across other projects. I'd say there's kind of a smaller universe of very sophisticated large GCs that serve as kind of the sandbox and testing bed in some ways for most startups in that space. And they have a lot of projects going on all the time. And so it's not traditional SaaS in the sense that, that one project is going to last you forever. But success in the limited time periods on each project usually leads to expansion across others, maybe even expansion within that project for more users, or however they're pricing it, more modules. But you want line of sight ultimately to kind of enterprise deals, and whether that's pre-seed, it's not really gonna, that'd be rare. Seed stage companies, maybe they have line of sight to one enterprise deal. Mm-hmm. Series A, you'd like to see a couple. Yeah. And then beyond that, it's like, how do you become a systems integrator? You work across enterprise. You talk to other systems and really just enable efficiencies outside of like your core offering. Mm-hmm. So it's for Contech kind of project management type of workflows, traditional SaaS, you can't really look at it as traditional SaaS. You just have to look at some of the outlook and the growth trends. Yeah.
I just think it's interesting because it poses a little bit of a risk if you're classifying it as traditional SaaS, right? I think that, while it's not like, there are opportunities for expansion, like you mentioned, like user licenses, internal upsells on particular projects. In my opinion, like the way you value the company, like maybe they don't deserve the traditional SaaS multiple that you're seeing. And like, part of it's me trying to make sense of and use a math-based approach to valuing early stage companies. Yeah. But I think you alluded to this before. It's like the capital markets are just insane right now, and so everything's overpriced. Nothing's really grounded in a lot of consistent math. Like anyone that actually tries to ground valuations and in like revenue-based math, everything's even forward-looking now, right? It's like, let's project out what this company is going to do over the next 12 months, and we'll use the multiple for that. So it's just like everything's being stretched. So yeah, I appreciate your thoughts there.
I think the really savvy founders, everyone gets put into these buckets of platform/venture play versus product or feature or point solution. It's very difficult to come out of the gates and sell a vision.
Mhm.
A lot of times, that's still the case of someone who maybe has built a company before, has had a successful outcome, can sell a vision.
Yep.
They almost put themselves on a different trajectory, even if they start out looking like, a point solution. And so, ultimately, it is ideal for a company to have a trajectory to go enterprise and have true recurring SaaS. And this is really just related like Context and GCs in particular.
Mhm.
If you can't sell a vision either way, it's very difficult to attract the interest, because ultimately venture dollars come in because there's billion-dollar outcomes, and that's not necessarily realistic for most of our companies. And there's models that work for sub-$1 billion. It's not like we'd expect every single one of our companies to sell for $1 billion. It's not realistic. But when you look at the Series B plus guys and some of the generalist growth stage, they need to be sold on a vision. Usually that requires like traditional SaaS metrics and solid unit economics, little churn, upsell to enterprise, but then a big, bold vision of how you can change the world, or at least just change the ecosystem and be $1 billion opportunity. So there's still some gamesmanship, and it requires kind of some bold gravitas from founders, kind of like an unrelenting pursuit to build a big business. And entering the space, you have to be very intentional and mindful that it's hard to do that overnight. It's impossible to do it overnight.
Yeah, absolutely. I'll ask one more question. I don't think I have seen any other questions come in.
Give people back some time on the calendars too.
Yeah, definitely. So my last question is just for like, in terms of how you're looking at the market in the sector, like what category and trend are you personally following most closely? Like, do you have a beat within Ironspring that you're kind of following?
Can't give away all of our secrets. There's some really interesting themes going on, and I've been tracking the reality contextualization space for a while, and we were launching Ironspring, construction site and open space had just been funded. Onsite IQ, I think, and Versatile had just gotten a seed round. And so that space has been very, very fun to watch and kind of track and see it evolve. The venture world moves ahead of, it tends to move ahead of real adoption. So it's taken some time for these companies to scale in. And but now that BIM is being more widely adopted and continue that trend, the value of data and site capture, external and interior, tied to BIM and tied to completion reporting, ultimately enabling what I think will be faster payments. And so you can kind of see where these things are going. It just takes a while, and it takes a war chest of capital, but that's a fun one to track, and I think it'll be impactful in our industry. Modular. We've seen a trend of on-site and off-site micro manufacturing from kind of construction tech team and GC owners, developers, and then independent groups also doing it. And I think we'll see like real productivity from just fundamental changes in constructioneering, construction processes, folks that can rethink how things are built. I won't name drop anybody, but there's some cool companies. One of our portfolio companies, Icon, is doing some really cool things, and kind of residential detached single unit housing, 3D printing. And it's fundamentally changing the landscape of building things. It's not a workflow. It's material science and software. It's vertically integrated supply chain. And so those types of things are going to be very, very impactful, whether it's interior steel framing for large commercial city centers, exterior modular framing. Some things that are coming online will be very, very cool. The last one I'll mention, is industrial blockchain application. We're starting to feel, I'm of the opinion it's within a venture fund life cycle, 10 years. These things will be highly impactful. We're already seeing some positive effects on supply chain, some of the transparency and immutability that it's bringing. And I don't think it'll be an open source world. I think there'll be permissioned private blockchains, probably one for each, one clear winner for each major sector, I'd imagine. But there's a lot of pursuit and focus and attention from large groups, whether it's Deloitte or Accenture, KPMG, or Oracle. I mean, there's a lot of groups that are working with folks like Hyperledger that have kind of a Switzerland fabric to integrate blockchain solutions. Ultimately, these things are going to look like, you're not going to say blockchain in these SaaS companies. They're going to be blockchain as a service companies. They won't even mention blockchain in their pitch.
Mm-hmm.
Just be able to improve things naturally. And kind of the way the world went when everyone was saying AI and raising on that, and ultimately, every company likely has some form of AI or is working towards it. You don't really need to put it in your pitch deck anymore.
Yeah.
I think blockchain is moving that way relatively soon.
Love it. Well, you gave us some good things to consider without, I think, giving away the magic sauce. So appreciate it.
So there's a question that came in.
Oh, is there a question?
How long can you self-fund before raising seed capital? Well, I guess that's very
sort of dependent on the actual founding team. Yeah.
Yeah, we've seen a lot of groups that bootstrap, and sometimes that makes sense to preserve kind of owner equity and dilution. They bootstrap themselves to a really solid company. It's difficult to do if you don't have kind of a surrounding close ecosystem of folks that might be able to support and raise, whether it's angels, friends, family, yourself, if you've made money. It's a great path to go down if you feel like you're surrounded by the right advisors and guidance, and maybe you've done the rodeo before and structuring properly and kind of getting the foundation in place for the venture route, if that is what you intend. There's a lot of groups that are doing pre-seed now in the form of safes, and you can still tap into some of the network, benefits of those folks, whether it's corporates or institutional VCs that take pre-seed exposure and maybe not even take a board seat, but just be a supporting person. But it's really kind of case by case. We'd recommend waiting as long as you can before accepting capital or taking on capital. You want to build a capital efficient business and know that you have something. And then once you do have something, there's going to be a slew of folks that will want to partner with you. Yep.
Similar answer from our perspective, Adam. So, Mark, to your question, I would say, from my perspective, venture funding, seed capital, is the most expensive form of capital you can give away, right? You're giving away your equity in your company. And the longer you can go, and I think the second piece of this is the longer you can go without having to raise capital and sell significant portions of equity into the business
without sacrificing growth.
The longer you can go, the easier it's actually going to be to raise your seed round, right? Because you're actually building momentum, traction. Hopefully, you have more case studies and support. Because really, from a seed perspective, this is our game. So we just play at seed, and if you can demonstrate really high quality traction with some notable names, you will be able to raise a seed round. Someone will write you a check. And if you can't prove that traction, if you haven't self-funded for long enough, maybe you didn't have enough capital and the runway wasn't long enough, that initial seed round is so much more difficult. You're really, really commoditizing yourself, and you're asking a venture investor to believe in your vision and your idea versus just showing them the facts, right? The facts, and how it will grow. You're extrapolating based on data, right? So I think it's a huge difference. But I think it's a great question. We're actually at time, but real quick, Adam. So definition of traction can often seem to be the beauty is in the eye of the beholder. Assuming demonstrated product market fit, can you add color on key metrics and evidence that you look for?
I think mandates are flexing every year. And, what was once kind of a mandate at Series A that you have $1 million in ARR is not necessarily like a hard and fast rule. The 5 million ARR that most Series B guys were asking for years ago, not really hard and fast. So it's kind of just an equation of time and traction. So if you built up 500K ARR in 7 months, okay, that's pretty good. You come out of the gates and you have kind of line of sight to growing. So I think it's, again, case by case. There's not hard and fast rules to the venture game necessarily, because I think the founders and startups are in a position of strength right now and will be for a while, and that's a good thing. I feel like that's how it should be. I think people building businesses should be able to pick their capital partner and who they want to work with, and not kind of be pigeonholed. And so there's opportunity to raise money if you're building a good business. I guess typical guidelines for like Series A, getting close to that $1 million ARR mark is always a good thing. What we've seen from the Series B guys, getting to 3 to 4 is now like the old 5, and so it's kind of all moving down. Again, if you raise 3 or 4 million bucks, or if your ARR is 3 or 4 million bucks and you've raised 20 million and you've been at it for 6-7 years, it's a different story. And if you've raised a couple $1 million and that's happened in the matter of 18 months or so. So it's all kind of relative. You wouldn't want to pin it to just hard and fast milestones, but that's kind of high level.
Fantastic.
I
would say all that checks out from our end too. Any other key metrics that we would look for? Yeah, again, so just for everyone's awareness, like Adam's going to play a little bit later than we do. Not in every instance, but certainly in some cases. I'd say well, first of all, I think the categorization of beauty is in the eye of the beholder with traction is 100% right. You can buy into traction very easily if you're convinced or persuaded by the entrepreneur, right? So I think it is important to keep that in mind, of that you can be biased and blinded. I'd say the key thing that we look for, that not just like a top level metric, but like what is the growth rate? Because if you have a specific growth rate that meets a minimum threshold, for us at Seed, we like to see like 30%, which is like very high, like month over month, 30%. If that's happening, if you're hitting, compounding monthly growth rate, like something really unique is happening in the market, right? So in terms of product market fit, like you're trying to identify not that people are just buying it, but that the market's reacting and that the adoption rate is like skewed. Like the adoption rate's happening so fast that there's like just that much fit with the product in the customer set. So I would add the growth rate is really important to us. The numbers, I think we could probably debate that. If you're starting from zero, like growing, initially 100% month over month is like very realistic. But once you hit a certain revenue threshold, like you start to do the math on doing 30% month over month at $1 million in revenue, it's like that's not trivial. Something's happening there with the business. So that'd be my addition. But yeah, great question, Mark. And so we're 5 minutes over. I want to first thank Adam for taking time out of his day. Adam spent a couple hours with us today. So again, thanks, Adam, for your perspective. I know hopefully a lot of founders listen to this conversation, because I think it was a lot of good insights there.